Disclaimer: this video is for informational and educational purposes only and should not be considered professional insurance or financial advice. I am not a licensed insurance agent or a financial advisor. To choose the right insurance policy tailored to your individual needs, you should consult with a qualified and licensed insurance professional. Insurance policies, terms, coverage, and premiums vary widely between companies and are subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.
I'll never forget the feeling. I was 19 years old, standing in a dealership parking lot, holding the keys to my very first car. A 10-year-old Toyota Camry that smelled faintly of pine tree air fresheners and shattered dreams. I was on top of the world. Freedom. That feeling lasted for exactly 12 minutes, until I realized I couldn't legally drive it off the lot without car insurance. An hour later, I was on the phone with an agent, completely lost in a sea of words I'd never heard before. Deductible, premium, bodily injury liability, collision, comprehensive. It was a foreign language. I felt stressed, confused, and honestly a little dumb. So I did what most first-timers do. I panicked, asked for the cheapest possible option, and signed on the dotted line just to make it stop. That single decision could have financially ruined me. Before we go any further, it's critical to state that the information in this video is for educational and informational purposes only. I am not a licensed financial advisor or insurance agent, and this presentation is not a substitute for professional advice tailored to your specific situation. Always consult with a qualified professional before making any financial decisions. Now let's be real. The auto insurance industry feels like it was designed to be confusing. It's an alphabet soup of policies and numbers that makes your eyes glaze over. They know that if you're confused, you're more likely to either overpay for coverage you don't need, or worse, cheap out and leave yourself dangerously exposed. Millions of Americans make these mistakes every single year, and it costs them dearly, sometimes everything they own. This video is going to change that for you. This is the guide I wish I had when I was 19. We are going to rip apart the confusion piece by piece. By the end of this presentation, you will understand exactly what you're buying, you'll know how to spot the traps, and you'll have a simple step-by-step blueprint to get the perfect amount of coverage for the lowest possible price. You will walk away from this feeling confident, in control, and ready to protect yourself and your future. So let's build your policy from the ground up, starting with the absolute, non-negotiable foundation of any auto insurance policy in the United States: liability coverage. Forget everything else for a moment. This is the one part of your insurance that is legally required in nearly every state. Why? Because it has nothing to do with protecting your car. It has everything to do with protecting everyone else from you. Liability insurance pays for the damage you cause to other people and their property if an accident is your fault. It's your financial defense shield. Without it, one bad turn, one moment of distraction, could lead to a lawsuit that follows you for the rest of your life. Liability coverage is typically broken down into two main parts, and you'll see it written as a series of 3 numbers, like 25/50/25. It looks like a secret code, but it's actually simple. Let's break it down. The first 2 numbers are for bodily injury liability. This covers medical bills, lost wages, and pain and suffering for people you injure in an accident. The first number is the maximum amount your insurance will pay for a single person's injuries. The second number is the maximum amount your insurance will pay for the total injuries of everyone in the accident, combined. The third number is for property damage liability. This one is straightforward. It pays to repair or replace whatever you hit, whether it's another car, a mailbox, a fence, or a storefront. So let's use that 25/50/25 example, which is a common state minimum requirement. The first 25 means your policy will pay up to $25,000 for one person's medical bills. The 50 means your policy will pay a maximum of $50,000 for all injuries in the entire accident. So if you injure 3 people, they have to share that $50,000 pot. And the final 25 means your policy will pay up to $25,000 to fix the other person's car or property. Now, here is the single most important piece of advice you will get in this entire video. Are you listening? The state minimum is a trap. It is a financial landmine disguised as a good deal. Choosing state minimum liability is one of the biggest mistakes a first-time insurance buyer can make. Let's paint a picture. You have that 25/50/25 policy because it was the cheapest. You're driving to work, you glance at your phone for a split second, and you rear-end a brand new Ford F-150. The driver and his passenger both have to go to the hospital. The driver has a broken wrist and whiplash. His medical bills come out to $30,000. His passenger has a concussion and needs weeks of physical therapy, totaling $25,000 in bills. The total medical cost is $55,000. Let's look at your policy. It only covers $25,000 per person, so you're good on the passenger. But for the driver, you are $5,000 short. And your total accident limit is $50,000, but the total bills are $55,000. So you're another $5,000 short. Right there, you are personally on the hook for $10,000 in medical bills. But we forgot about the truck. That new F-150? It's not a cheap vehicle. The repair bill comes in at $28,000. Your property damage limit is only $25,000. So you are now also on the hook for another $3,000 to fix the truck. In a split second, your cheap insurance policy has left you with a personal bill of $13,000. And that's a relatively minor accident. What if you had hit a BMW or a Tesla? The average price of a new car in America is now over $48,000. Your $25,000 property damage limit wouldn't even come close to replacing it. What if the accident was more serious? What if someone needed surgery that costs $100,000? What if they couldn't work for 6 months and sued you for lost wages? Your state minimum policy would be exhausted in an instant. And when the insurance money runs out, where do you think they look next? They look to you. They will sue you personally for the difference. And if you can't pay, a court can order your wages to be garnished. They can put a lien on your property. They can seize your assets and savings. A single mistake made because you tried to save $15 a month on your insurance premium could cripple you financially for decades. So what should you do? You need to protect your future self. For the vast majority of people, I strongly suggest looking at liability limits of at least 100/300/100. Let's translate that. $100,000 for a single person's injuries. $300,000 for total injuries in an accident. $100,000 for property damage. This level of coverage provides a robust, powerful shield around your financial life. It protects you from all but the most catastrophic of accidents. And here's the best part. The price difference between the pathetic state minimum and this level of real protection is usually not that much. We're often talking about the cost of a few cups of coffee a month. It is the single best investment you can make in your own peace of mind. When you're getting quotes, ask the agent to show you the price for the state minimum, and then the price for 100/300/100. You will be shocked at how little it costs to buy yourself hundreds of thousands of dollars in extra protection. This is your foundation. Getting your liability coverage right is step one to building a policy that actually protects you. Don't fall into the trap of thinking cheapest is best. When it comes to liability, cheapest means most dangerous. You've worked hard to get where you are, and you have a whole future of earning ahead of you. Protect it fiercely. Now that we've built the fortress to protect you from damaging others, what about protecting your own car? What happens if you hit a deer? Or a tree falls on your car? Or someone steals it? That's where the next two critical pieces of your policy come in. Collision and comprehensive coverage. And understanding how they work together, and how to choose the right deductible, is the key to not overpaying. Collision and comprehensive are often called physical damage coverages, and they're all about one thing: fixing or replacing your car. Let's break them down with a story. Imagine you're driving to work, jamming out to your favorite song. You're approaching a stoplight, it turns yellow, you slow down. But the person behind you doesn't. Bam! You get rear-ended. Your bumper is toast, your trunk is crumpled. It's clearly the other driver's fault. In a perfect world, their liability insurance, which we talked about in the last part, would pay for everything. But what if they don't have insurance? Or what if their coverage isn't enough to fix your brand new SUV? Or what if, and this is the one people forget, what if the accident is your fault? What if you're the one who accidentally slides on a patch of ice and hits a telephone pole? That's where collision coverage saves the day. Collision insurance pays to repair or replace your car if it's damaged in a collision with another object. That could be another vehicle, a guardrail, a building, a pothole you didn't see, you name it. The most important thing to remember is that it pays out regardless of who is at fault. It is your safety net for the physical value of your car in an accident. If you cause the crash, it pays. If a hit-and-run driver smashes your car while it's parked and disappears, it pays. If an uninsured driver hits you, it pays. It is the coverage that protects your investment from the chaos of the road. Now let's change the scene. Your car is safely parked in your driveway overnight. You wake up the next morning, and a massive tree branch has fallen during a storm, shattering your windshield and caving in your roof. Or maybe you live in an area with hailstorms, and your car now looks like a golf ball. Or you walk out of the mall to find your car is just gone, stolen. None of those things are a collision. You didn't hit anything. This is where comprehensive coverage steps in. Think of comprehensive as the everything else or act of God coverage. It protects your car from damage not caused by a collision. This includes things like theft, vandalism, fire, falling objects, floods, hail, and even hitting an animal like a deer. Hitting a deer is one of the weirdest exceptions in insurance. It's not considered a collision. It falls under comprehensive. Why? The logic is that you can't really swerve to avoid a telephone pole, but a deer can jump out from anywhere. It's considered a random, non-driving event. So collision is for crashes. Comprehensive is for chaos. Now the big question you're probably asking is, do I actually need both of these? The answer depends on two things: who owns your car and how much it's worth. First, the ownership question. If you have a loan on your car or if you're leasing it, the answer is simple. Yes, you need both. It's not optional. Your lender or leasing company requires you to have full coverage, which means liability, collision, and comprehensive, because technically they own the car until you pay it off. They are protecting their asset. If you wreck the car and don't have the insurance to fix it, you still owe them the money, and they're left with a worthless piece of metal. So they mandate it in your loan agreement. If you have a loan or a lease, you can stop thinking about it. You must have them. But what if you own your car outright? What if you paid cash for it or you finally paid off that loan? Now you have a choice. And this is where you can save a lot of money or make a very costly mistake. The decision comes down to your car's value and your personal financial situation. Insurance companies will only pay up to the actual cash value, or ACV, of your car at the time of the accident. ACV is basically what your car was worth 1 second before it was damaged. It's the replacement cost minus depreciation. So, if you're driving a 15-year-old car with 200,000 miles that's worth maybe $2,000, does it make sense to pay an extra $500 or $600 a year for collision and comprehensive coverage? Probably not. The cost of the insurance could quickly add up to more than the car is even worth. In a worst-case scenario, if you total the car, the insurance company is just going to write you a check for its $2,000 value, minus your deductible. In this case, you might be better off self-insuring. That is, dropping collision and comprehensive, saving that money on your premium, and putting it aside in an emergency fund to buy a new beater if something happens. On the other hand, if your car is only a few years old and worth $25,000, dropping this coverage would be a massive financial risk. Could you afford to just walk away from a $25,000 asset if it got totaled tomorrow? For most people, the answer is a hard no. In that case, paying for collision and comprehensive is absolutely essential. This brings us to the most important lever you can pull to control the cost of this coverage: the deductible. What is a deductible? It's the amount of money you agree to pay out of pocket for a claim before the insurance company pays a single dime. It's your share of the risk. You see it on every quote, with options like $250, $500, $1,000, or even $2,000. Here's how it works in the real world. Let's say you have a $500 deductible for your collision coverage. You get into that fender bender, and you take your car to the body shop. The estimate to fix it comes back at $4,000. With a $500 deductible, you pay the first $500 directly to the repair shop. Your insurance company then pays the remaining $3,500. If the damage was only $400, it's all on you. Your insurance doesn't get involved because the cost is less than your deductible. The relationship between your deductible and your premium, the price you pay for your policy, is an inverse one. It's a seesaw. A low deductible like $250 means you pay less if you have an accident. But because the insurance company is taking on more risk, they charge you a higher premium. A high deductible like $1,000 or $2,000 means you'll have to pay a lot more out of pocket if you file a claim. But because you are taking on more of the risk yourself, the insurance company rewards you with a much lower premium. So, how in the world do you choose the right one? This is maybe the most practical piece of financial advice you will ever get about insurance. The golden rule is this: your deductible should be the absolute highest amount you can comfortably afford to pay at a moment's notice without going into debt or financial distress. Read that again. The amount you could get your hands on tomorrow from your emergency fund without having to sell something or put it on a high-interest credit card. If you have $5,000 saved up for emergencies, choosing a $1,000 deductible is a smart move. You'll save a significant amount on your yearly premium. And if something happens, you can easily cover the deductible from your savings. But if you're living paycheck to paycheck and a surprise $500 bill would be a catastrophe, then you should not choose a $500 deductible. You might be forced to choose a lower $250 deductible. Yes, your monthly premium will be higher and it will be a pain. But that pain is more manageable than suddenly needing to come up with $500 you simply don't have just to get your car back on the road so you can get to work. Let's look at the math. An insurance company might quote you a premium that's $400 cheaper per year if you raise your deductible from $500 to $1,000. That sounds great. You're saving over $30 a month. But what you're really doing is making a bet. You are betting that you won't have an accident. You are saving $400 in premium, but you are taking on an extra $500 of risk, $1,000 deductible, minus the old $500 deductible. If you go a year and a half without an accident, you've won the bet. But if you have an accident in the first year, you've lost because you'll be paying that extra $500 out of pocket, which wipes out your premium savings. There's no single right answer. Only the right answer for your financial situation and your tolerance for risk. And here's a pro tip most first-timers miss. You can often set different deductibles for collision and comprehensive. It might be smart to have a higher deductible for collision, say $1,000, because you have some degree of control over whether you get into a crash. But you might want a lower deductible for comprehensive, say $250, for things you have zero control over, like a rock cracking your windshield or a hailstorm. The premium difference is often small, and it gives you peace of mind for those truly random events. So to recap, collision covers your car in a crash. Comprehensive covers it from theft, weather, and other non-collision chaos. If you have a loan, you must have them. If you own your car, you must weigh its value against the cost of the coverage. And your deductible is your skin in the game. Set it as high as your emergency fund can comfortably handle to get the lowest premium. We've now covered how to protect your own car. But we're still left with the biggest, scariest, and most important part of any auto insurance policy. What happens when you cause a serious accident? What happens when you're responsible for not just a crumpled bumper, but for someone else's medical bills, lost wages, and pain and suffering? That's where liability limits come in. And choosing the wrong number here can financially ruin you for life. Let's break down those numbers you see on an insurance quote, the ones that look like a secret code, 25/50/25, or 50/100/50, or even 100/300/100. This isn't just random math. This is the exact dollar amount your insurance company will pay out if you cause an accident. This is your financial shield. And understanding this shield is the single most important thing you will do when buying insurance. Liability coverage is split into two main parts: bodily injury and property damage. Bodily injury, or BI, covers the medical costs for people you injure in an accident. And not just their hospital bills. We're talking about their physical therapy, lost income because they can't work, and even compensation for their pain and suffering. Property damage, or PD, is simpler. It covers the cost of repairing or replacing whatever you hit. The other person's car, a mailbox, a storefront, a guardrail. You name it. Now let's decipher that code. When you see three numbers like 50/100/50, here's what they mean. The first number, 50, in this case, stands for $50,000. This is the maximum amount your insurance will pay for any one person's bodily injuries in an accident you cause. One person, one limit. The second number, 100, stands for $100,000. This is the maximum total amount your insurance will pay for all bodily injuries combined in a single accident. So if you injure three people, this $100,000 is the entire pot of money available to be split between them, with no single person getting more than the $50,000 individual limit. The third number, the final 50, is $50,000 for property damage. This is the maximum amount your policy will pay to repair or replace all the property you damaged in that one accident. So, 50/100/50 means $50,000 per person, $100,000 total for injuries, and $50,000 for property damage. Now let's put this into the real world. Imagine you're driving on a rainy evening. You glance at your phone for a split second, and when you look up, brake lights are staring you in the face. You slam on your brakes, but it's too late. You rear-end a brand new Toyota Highlander. The driver and passenger in the Highlander both get whiplash and need to go to the emergency room. The driver, a surgeon, can't perform surgery for 2 weeks, losing significant income. The passenger needs months of chiropractic care. Your car is totaled, but we're not even talking about that yet. We're only talking about the damage you caused to others. The final bill comes in. The Highlander is a total loss. Replacement cost, $45,000. The surgeon's medical bills plus lost wages come to $55,000. The passenger's medical bills total $20,000. The total damage you caused is $120,000. Now let's look at your insurance. You thought you were being smart. You went online, found the cheapest possible option, and bought the state minimum coverage. In a state like California or Florida, that might be something as low as 15/30/5 or 25/50/25. Let's be generous and say you have 25/50/25. $25,000 per person for injuries. $50,000 total for injuries. $25,000 for property damage. Let's do the math. The Toyota Highlander costs $45,000 to replace. Your policy only covers $25,000 in property damage. That leaves a $20,000 bill. That bill has your name on it. Now for the injuries. The passenger's medical bills are $20,000. Your per person limit is $25,000, so you're covered there. Phew. But the surgeon's costs are $55,000. Your policy only covers $25,000 for that one person. That leaves a $30,000 shortfall. That bill also has your name on it. So, after your cheap insurance pays out its maximum, you are personally on the hook for $50,000. And that's from a simple everyday rear-ender. $50,000. Do you have that sitting in a bank account? If you don't, they don't just forget about it. The other party's insurance company will pay their client, and then their lawyers will come after you to get that money back. They will sue you, and they will win. A court judgment against you means they can garnish your wages. That means for years, maybe even decades, a portion of every single paycheck you earn will be taken from you before you ever see it. They can put a lien on your assets. If you ever hope to own a home, that dream could be in serious jeopardy. This one little accident, this one bad choice on your insurance limits, could literally follow you for the rest of your financial life. State minimum insurance is not a safety net. It is a legal trap. It exists only to make you technically legal to drive, not to actually protect you from anything more than a fender bender with a 10-year-old Corolla. In today's world of $60,000 pickup trucks and basic air visits that cost more than a vacation, state minimums are a joke. So what's the right number? The honest answer is, as much as you can possibly afford. Most financial experts will tell you that a responsible bare minimum for anyone who has a job and wants a future is $100,000/300/100. $100,000 per person injured. $300,000 total for injuries. $100,000 for property damage. Let's replay our accident with these limits. The $45,000 Highlander? Your $100,000 property damage limit covers it completely. The $55,000 bill for the surgeon? Your $100,000 per person limit covers it completely. The $20,000 bill for the passenger? Covered. Instead of a $50,000 lawsuit and garnished wages, you have a $500 or maybe a $1,000 deductible to pay. You write one check and it's over. Your insurance company handles the lawyers, the claims, the stress. You are made whole. You get to move on with your life. That is what insurance is for. Now you're probably thinking, okay, but coverage that's 4 times better must cost 4 times more, right? I can't afford that. And this is the biggest secret the insurance industry doesn't scream from the rooftops. The price difference between disastrous state minimum coverage and solid 100/300/100 protection is shockingly small. We're often talking about the price of a few cups of coffee a month, maybe 10, 20, or 30 extra dollars on your monthly premium. Why? Because the risk of a small accident is very high, so the base cost of insurance is baked into those low limits. The risk of a catastrophic policy maxing out accident is much lower, so the cost to add on that extra life-saving protection is marginal. You get the most bang for your buck on the higher end of liability coverage. So when you get your quotes, I want you to do an experiment. Get a quote for the state minimum. Then, on that same website, slide the liability coverage up to 100/300/100. Watch the price. See for yourself how little it costs to buy a financial fortress instead of a cardboard shield. You are not just buying car insurance. You are buying a defense against financial ruin. You are protecting your future paychecks, your ability to get a loan, your peace of mind. Choosing anything less than 100/300/100 is like stepping into a boxing ring wearing a t-shirt instead of headgear. You might be technically in the ring, but you are not protected. Now you've built a strong shield to protect you from the damage you might cause to others. You've been responsible. But what happens when the tables are turned? What happens when someone without insurance, or with that same garbage state minimum policy, smashes into you? Who pays for your car, your medical bills, your lost wages then? Because now you're the victim, and their flimsy policy isn't going to cover it. You could do everything right and still be left with a totaled car and a mountain of medical debt. That's where the other side of your policy comes in, the part that protects you from them. And that's what we're breaking down next. Let's start with a scenario. You're driving home on a Friday afternoon. Traffic is a little heavy. You're stopped at a red light, listening to a podcast, thinking about your weekend plans. Suddenly, bam, a violent jolt throws you forward. You've been rear-ended. Hard. Your neck snaps back. Your car is pushed into the intersection. You're dazed, but you manage to get out. The other driver is incredibly apologetic. He admits it was totally his fault, he was looking at his phone. You exchange information. His insurance card looks legit. You go to the hospital, get checked out for whiplash. Your car is towed to a body shop. Few days later, you get 2 phone calls. The first is from the body shop. Your car's frame is bent. It's totaled. The second call is from the other driver's insurance company. And this is the call that turns your life upside down. They say, "We're sorry, but our client let his policy lapse last month. He has no coverage." Suddenly, you are on your own. You have a $10,000 medical bill, a $25,000 car that is now a worthless hunk of metal, and the guy who did this to you has no insurance and no assets. He can't pay. So who does? You do. Every single penny comes out of your pocket. Unless you have 2 of the most important, yet most misunderstood, coverages on your policy: uninsured and underinsured motorist coverage. This is the protection you buy for yourself against the unknown. It's a shield against the 1 in 8 drivers in the United States who are on the road right now with absolutely no insurance. Think about that. On your average commute, you will pass dozens, maybe hundreds of cars. Statistically, a significant number of them are rolling liabilities, one mistake away from causing financial ruin with no way to pay for it. Let's break it down. First is uninsured motorist coverage, or UM. It's exactly what it sounds like. It pays for your expenses when you are hit by a driver who has 0 insurance. It also covers you in a hit and run, where the driver is unidentified and, for insurance purposes, is treated as uninsured. UM coverage is typically split into 2 parts, just like liability. You'll see uninsured motorist bodily injury, or UMBI. This is the crucial one. It covers your medical bills, your passengers' medical bills, and can even cover lost wages and pain and suffering if you're seriously injured and can't work. The second part is uninsured motorist property damage, or UMPD. This, as you'd guess, pays to repair or replace your car if it's damaged by an uninsured driver. So, in our nightmare scenario, if you had UMBI, it would have paid that $10,000 medical bill. If you had UMPD, it would have written you a check for the value of your totaled car. You would have been made whole. Your savings account would be untouched. Now, what about the second, more subtle threat? This is the one that catches even savvy people by surprise. It's called underinsured motorist coverage, or UIM. This protects you when the at-fault driver does have insurance, but they only have the bare minimum required by the state. And trust me, the state minimum is almost never enough for a serious accident. Let's change our scenario slightly. The guy who rear-ended you does have insurance. He has the state minimum for California, $15,000 for a single person's bodily injury, and only $5,000 for property damage. $5,000. Your medical bills are $10,000. His insurance pays that. You're covered, right? Well, what about your car? Your $25,000 car is totaled. His policy only has $5,000 of property damage liability. That's all they will ever pay you. They'll cut you a check for $5,000 and wish you the best of luck. You are now out $20,000 on your car. Where does that money come from? It comes from your underinsured motorist coverage. Your UIM policy would kick in and pay the remaining $20,000 to cover the gap between his pathetic limit and the actual value of your car. Just like UM, underinsured motorist coverage is split into bodily injury, UIMBI, and property damage, UIMPD. They work together as your financial safety net. Now, a critical question people ask is, Wait, if I have collision coverage to fix my car, do I really need uninsured or underinsured property damage coverage? It's a great question, and the answer is yes, you probably still do. Here's why. First, your collision coverage almost always has a deductible. If your car is totaled by an uninsured driver and you use your own collision coverage, you're still paying that $500 or $1,000 deductible out of pocket. UMPD often has a much lower deductible, sometimes as low as $0. Second, a not-at-fault accident paid for by the other driver's insurance, or your UMPD coverage acting in its place, is generally viewed more favorably by your insurance company than a claim on your own collision coverage. It's less likely to impact your future rates. Think of UMPD as the cleaner, cheaper, better way to get your car fixed when someone else is at fault but can't pay. So how much UM/UIM coverage should you get? The standard, expert advice is simple. Match your uninsured and underinsured motorist limits to your own bodily injury and property damage liability limits. The logic is flawless. If you believe you need $100,000 of liability coverage to protect your assets from a stranger you might injure, why on earth would you not give yourself and your family that same $100,000 layer of protection from a stranger who might injure you? It makes no sense to be underinsured yourself when you're protecting others. It's usually a surprisingly small increase in your premium for a massive increase in peace of mind. But we're not done protecting ourselves yet. There's another pair of coverages designed for your immediate well-being, regardless of who is at fault. These are medical payments coverage, often called MedPay, and personal injury protection or PIP. Let's go back to that rear-end collision one last time. The accident just happened. The police are there, the ambulance arrives. Who pays for that ambulance ride? Who pays for the emergency room visit? In the real world, figuring out who is at fault and getting the other person's insurance to pay can take weeks, even months. But the hospital wants its money now. This is where MedPay comes in. MedPay is a small bucket of money, typically ranging from $1,000 to $10,000, that covers medical expenses for you and anyone in your car, no matter who caused the accident. It is immediate. There's no finger pointing, no waiting for a police report to be finalized. You were in an accident in your car, so your MedPay kicks in right away. It can cover your health insurance deductible, co-pays, dental work if you chipped a tooth on the steering wheel, or physical therapy down the road. It's an incredibly valuable, and usually very inexpensive coverage to add. If you have a high-deductible health insurance plan, having $5,000 in MedPay is one of the smartest financial decisions you can make. It acts as a buffer, so a car accident doesn't drain your savings before your main health insurance even starts to pay. Now, in about a dozen states, this concept is taken a step further with something called personal injury protection, or PIP. These are known as no-fault states. If you live in one of them, like Florida, New York, or Michigan, you'll be required to buy PIP. Think of it as MedPay on steroids. Like MedPay, PIP covers your medical bills regardless of fault, but it goes much further. PIP can also cover lost wages if you're unable to work for a few weeks while you recover. It can even cover what are called essential services. For example, if you're a stay-at-home parent and you break your leg in an accident, your PIP coverage could actually pay for childcare services while you're laid up. It is comprehensive protection for your life, not just your body. In these no-fault states, the idea is that everyone's own insurance handles their own initial injuries, which dramatically speeds up payments and cuts down on smaller lawsuits. So, to recap this crucial piece of the puzzle, uninsured and underinsured motorist coverages are your shield against the millions of irresponsible or underinsured drivers on the road. They protect your savings, your health, and your property from someone else's mistake. MedPay and PIP are your personal first aid kit. They provide immediate financial relief for injuries, bridging the gap and paying the upfront costs so you can focus on getting better, not on fighting with insurance companies. So now you're protected from financial ruin if you hurt someone, and you're protected if someone without enough insurance hurts you. But what about the single most expensive physical object involved in most accidents? Your actual vehicle. What happens when your brand new car is a twisted wreck on the side of the highway, or a tree falls on it in your driveway? That's when you'll be glad you understood the difference between collision and comprehensive coverage. And that's exactly what we're decoding next. Let's start with collision. Picture this. You're leaving the grocery store, backing out of a tight parking spot. You're checking your mirrors, you're turning your head, but the pillar of the parking garage is in the perfect blind spot. Crunch. That sickening sound of metal scraping against concrete. You get out, heart pounding, and see a massive deep gash running from your rear door all the way to the taillight. It's your fault. No one else was involved. Just you, your car, and a very unforgiving concrete pillar. This is exactly what collision coverage is for. It pays to repair or replace your car after it's damaged in a collision with another object. That object could be another car, a guardrail, a telephone pole, a fire hydrant, or even that sneaky parking garage pillar. It also covers damage from flipping your car over in an accident. Essentially, if you are operating the vehicle and it makes impact with something, collision coverage is your hero. But it doesn't pay for everything. This is where we need to talk about one of the most important words in insurance: the deductible. Your deductible is the amount of money you have to pay out of your own pocket for a claim before your insurance company pays a single penny. Think of it as your copay for a car repair. Let's go back to that scraped-up car. You take it to the body shop, and the mechanic gives you the bad news. The repair is going to cost $3,000. If you have a $500 collision deductible, you will write a check for $500. Your insurance company will then cover the remaining $2,500. If you have a $1,000 deductible, you pay $1,000, and they pay $2,000. You choose your deductible amount when you buy your policy. A higher deductible usually means a lower monthly payment, but it also means more financial pain if you have to file a claim. We'll come back to how to choose the right number in a minute because it's a critical decision. So, collision covers you when you hit something. But what about all the other horrible things that can happen to a car? Now, I want you to imagine a different scenario. Your car is parked safely on the street in front of your house. You wake up one morning, and there's been a massive overnight hailstorm. You look outside and your beautiful new car looks like a golf ball. It's covered in hundreds of dents. Or a huge branch from your neighbor's oak tree snaps in a windstorm and crushes your roof. Or you walk out of a movie theater to find your car is just gone. Stolen. In all of these cases, you didn't collide with anything. These events were completely out of your control. This is the domain of comprehensive coverage. It's sometimes called other than collision coverage, which is a perfect description. It covers damage to your car from things like theft, vandalism, fire, falling objects, storms, floods, and hitting an animal. Yes, if a deer decides to play chicken with your front bumper and loses, the damage to your car is handled by your comprehensive coverage, not collision. It's a weird rule but a crucial one. A collision with an animal is one of the most common comprehensive claims. Just like collision, comprehensive coverage has its own deductible. And here's a pro tip. Your comprehensive deductible does not have to be the same as your collision deductible. Many people choose a lower deductible for comprehensive, say $250, because claims like a cracked windshield from a rock on the highway are relatively common and less expensive to fix than a major collision. So now you know the difference. Collision is for hitting things. Comprehensive is for everything else. This brings us to the million-dollar question. Do you actually need them? Legally, in nearly every state, the answer is no. The government only requires you to have liability insurance, which we'll cover in the next section. Liability pays for damage you do to other people. It does nothing for your own car. So if collision and comprehensive are optional, why does almost everyone with a new car have them? The answer in 2 words: the bank. If you have a loan on your car or if you're leasing it, you don't technically own it yet. The lender or leasing company does. And they have a vested interest in making sure their asset, your car, is protected. They will absolutely require you to carry both collision and comprehensive coverage until the car is paid off. If you don't, they can buy a policy for you and charge you an astronomical price for it. So, if you have a loan, the decision is made for you. You need both. But what if you own your car outright? What if you're driving a 12-year-old Toyota that's been paid off for years? This is where it gets interesting. This is where you have to think like an insurance company. The decision to carry collision and comprehensive on an older car comes down to a simple cost-benefit analysis. First, you need to know your car's actual cash value or ACV. This is not what you paid for it. It's not what you think it's worth. It's what it's worth in the current market, taking into account its age, mileage, and condition. You can get a good estimate from sites like Kelley Blue Book or Edmunds. Let's say your trusty Toyota is worth $3,000. Now look at your insurance policy or get a quote. How much are you paying per year specifically for the collision and comprehensive portion of your premium? Let's say it's $500 a year. Here's the math you need to do. If you get in a bad accident and total the car, the absolute most your insurance company will pay you is that $3,000 actual cash value minus your deductible. So if you have a $500 deductible, you'd get a check for $2,500. Now ask yourself, Is it worth paying $500 every year to protect a potential payout of $2,500? In this case, you're paying 1/5 of the car's value every single year just to insure it against physical damage. After a few years, you will have paid more in premiums than you could ever get back from a claim. For many people with older low-value cars, it makes financial sense to drop collision and comprehensive. This is a form of self-insuring. You take the money you would have spent on those premiums and you put it in a savings account. You're betting on yourself to be a safe driver. If you do get into an accident and it's your fault, you'll have to pay for the repairs, or scrap the car and buy a new one, using your own money. It's a calculated risk. A common rule of thumb is this: if your car is worth less than 10 times the annual premium for collision and comprehensive, you should seriously consider dropping them. Okay, let's circle back to deductibles for a moment, because choosing the right one can save you hundreds of dollars a year. The relationship is simple. The higher your deductible, the lower your monthly premium. The lower your deductible, the higher your premium. Insurance companies are rewarding you for taking on more of the financial risk yourself. So what's the right number? A $50 deductible? A $2,000 deductible? The answer is intensely personal, but here is the single best piece of advice I can give you. Your deductible should be the absolute highest amount of money you could comfortably pay out of pocket tomorrow, without notice, without completely wrecking your budget or going into debt. If you have a healthy emergency fund with several $1,000s in it, a $1,000 or even a $1,500 deductible might be a fantastic choice. You'll save a significant amount on your premiums, and if something happens, you can easily cover the deductible from your savings. But if you're living paycheck to paycheck and a surprise $500 bill would be a catastrophe, then you need to choose a lower deductible like $250. You'll pay more each month, but you're buying peace of mind, knowing that a small fender bender won't send you into a financial spiral. Don't try to be a hero and pick a high deductible just to save a few bucks a month if you can't actually afford it. We've just spent all this time talking about how to protect and fix your $10,000, $20,000 or $50,000 car. That's important. But it's nothing, and I mean nothing, compared to the financial damage you can do to someone else. What happens if you run a red light and hit a surgeon in a brand new Mercedes, putting him out of work for a year? What happens if you cause an accident that involves multiple cars and sends 3 people to the hospital? The cost of fixing your own car is a rounding error compared to the medical bills, lost wages, and lawsuits that can follow. We're talking about claims that can reach hundreds of thousands or even millions of dollars. And that is where the most important part of your entire insurance policy comes into play. It's the one part the law requires, and the one part that can single-handedly protect you from total financial ruin. It's called liability coverage, and understanding how it works is the key to not just being insured, but being truly protected. And that's what we're breaking down next. Let's start with a story. Imagine a guy named Alex. He's 22, just landed his first real job, and bought his first car, a reliable, used Honda Civic. He's proud. He's independent. Now he needs insurance. He calls an agent and his main goal is simple: get the cheapest possible rate. The agent says, well, you can get the state minimum liability coverage. It's the lowest we can legally sell you. Alex, thinking about his rent and student loans, says, perfect. Sign me up. He's saving about $30 a month. He feels like he just hacked the system. A few months later, Alex is driving home from work. It's raining, the roads are slick. He's following a brand new Lexus SUV. He glances down for a split second to change a song on his phone. When he looks up, brake lights. He slams his own brakes, but it's too late. He skids right into the back of the Lexus. It's not a huge crash. No airbags deployed. Everyone seems okay. The Lexus has a dented bumper. His Civic has a crumpled hood. They exchange information. Alex calls his insurance company, files the claim, and thinks, well, this stinks, but that's what I have insurance for. This is the exact moment where his $30 a month decision will either save him or ruin him. Because here's what Alex doesn't understand about liability coverage. It's not for you. It's not for your car. It's for the other person. It's the coverage that pays for the damage you cause to other people and their property when an accident is your fault. The word liability literally means responsibility. This coverage handles your financial responsibility to others, and it's split into 2 critical parts. The first part is property damage liability. This pays to repair or replace whatever you hit. The other person's car, a mailbox, a storefront, a city guardrail. In Alex's case, it's for the Lexus's bumper. Now, Alex lives in a state where the minimum property damage coverage is $10,000. He thinks, a bumper can't cost $10,000, right? Wrong. The estimate for the Lexus bumper comes back. It's not just a piece of plastic. It's a complex component filled with backup sensors, blind spot monitoring radar, and a special 3-stage pearl paint job. The total repair bill, $9,200. Alex breathes a sigh of relief. His $10,000 limit covers it. He's good. But what if he hadn't hit a Lexus? What if he had swerved and hit a brand new Mercedes S-Class, where a simple fender bender can easily top $20,000? What if he had lost control and caused a 3-car pileup? His insurance would pay the first $10,000, and then they'd wash their hands of it. The other drivers' insurance companies wouldn't just forget about the rest. They would sue Alex personally for the remaining balance. His future wages could be garnished. That brilliant feeling of saving $30 a month would vanish, replaced by a bill for $10,000 or $20,000 or $50,000 that he would be paying off for the next decade. And that's just the property damage. We haven't even gotten to the dangerous part. The second part of liability is called bodily injury liability. This is the one that can truly bankrupt you. This coverage pays for the other person's medical expenses, lost wages from being unable to work, and even pain and suffering if you injure them in an accident. This is where you see those 3 numbers on an insurance quote like 25/50/10. The first 2 numbers are for bodily injury. The last one is for property damage, which we just talked about. Let's break down those first 2 numbers. In a 25/50 policy, the first number, 25, means your insurance will pay up to $25,000 for a single person's injuries in an accident you cause. The second number, 50, means your insurance will pay a maximum of $50,000 total for injuries in a single accident, no matter how many people are hurt. Alex's state minimum policy was 25/50. He hit one person, the driver of the Lexus. At the scene, she said she was fine, just a little shaken up. But a week later, she wakes up with severe neck pain. Her doctor diagnoses her with whiplash. She needs physical therapy 3 times a week. She needs prescription medication. She's a freelance web developer, and the pain makes it impossible to sit at a computer for more than an hour. She's losing clients and income. Her medical bills quickly climb to $20,000. Her lost wages are calculated at another $15,000. That's a total of $35,000. Alex's insurance company writes a check for $25,000, the absolute maximum on his policy for one person. So where does the other $10,000 come from? Comes from Alex. The woman's lawyer sends a letter to Alex's apartment demanding payment. Suddenly, he's on the hook for $10 grand. All his savings are gone. He's taking on credit card debt. And he got lucky. What if she had needed surgery? An MRI? What if her injuries were permanent? A single serious injury can easily exceed $100,000, $200,000, even $1 million in costs. His $25,000 policy would have been a single drop of water on a raging fire. And what if he hadn't just hit a driver, but a family of 4 in a minivan? Let's say all 4 are injured. His policy limit is $50,000 total for the entire accident. That's barely $12,000 per person. It wouldn't even cover the cost of their ambulance rides and emergency room visits. Once his insurance company pays out that $50,000, they're done. The rest of the medical bills, the lost wages for multiple people, the lawsuits for pain and suffering, all of it would fall directly on Alex. They would come for his savings account. They would come for his car. They would put a lien on any property he ever hoped to own. His paychecks would be garnished for years, maybe decades. His entire financial future, his ability to buy a house, to save for retirement, to have any kind of financial freedom would be completely derailed. All to save $30 a month. Choosing liability limits is not about checking a box to be legal. It is the single most important financial decision you will make when buying car insurance. It is a measure of the shield that stands between a simple mistake and total financial devastation. State minimums are a joke. They were set decades ago and haven't kept up with the modern costs of cars and healthcare. Driving with state minimum coverage is like showing up to a gunfight with a butter knife. It's technically a weapon, but it's not going to do you any good. So what's the right amount? Most financial experts agree you should never carry less than 100/300/100. Let's translate that. $100,000 for a single person's injuries. $300,000 total for all injuries in an accident. And $100,000 for property damage. This might sound expensive, But the shocking truth is that the jump from a dangerously low 25/50/10 policy to a securely protective 100/300/100 policy is often surprisingly small. We're not talking about doubling your premium. We're often talking about an extra $15, $20, maybe $35 a month, the price of a few fancy coffees or a Netflix subscription. You are paying for peace of mind. You are paying to protect your future. When you're getting quotes, ask to see the price difference between the state minimum and a 100/300/100 policy. Then ask to see the price for a 250/500/100 policy. The small increase in your monthly payment buys you a massive increase in your financial armor. This is the one place you absolutely cannot afford to be cheap. Because liability coverage isn't really car insurance. It's don't lose everything you ever worked for insurance. But liability only covers the people you hit. What about you? What about your own car? If you're at fault, liability coverage pays you nothing for your own medical bills and does nothing to fix your crumpled hood. For that, you need two entirely different types of coverage, and they're just as crucial. The first of these is called collision coverage, and the name says it all. This is the coverage that pays to repair or replace your car if you are in a collision with another object, usually another car, but it could also be a pole, a guardrail, or a fire hydrant. It doesn't matter who is at fault. If you back into a light pole in a parking lot, collision coverage is what you'll use. If another driver runs a red light and plows into you, you could use your collision coverage to get your car fixed immediately instead of waiting weeks or months for the other driver's insurance to finally admit fault and pay up. Your insurance company will then go after their company for the money, a process called subrogation, but you don't have to worry about that. You get your car fixed now. But here's the catch, and it's a big one: the deductible. A deductible is the amount of money you have to pay out of your own pocket for a repair before the insurance company pays a single penny. It's like a copay for your car. Deductibles typically range from $250 to $1,000, or even more. Let's say you have a $500 deductible. You get into an accident that causes $4,000 of damage to your car. You will pay the body shop the first $500, and your insurance company will cover the remaining $3,500. If the damage is only $400, well, since that's less than your deductible, you're paying for the whole thing yourself. Insurance isn't even involved. So why would you choose a higher deductible? Because it lowers your premium. The more financial risk you're willing to take on yourself, the less the insurance company charges you every month. A $1,000 deductible will give you a much cheaper policy than a $250 one. The most important question to ask yourself is this: if I get in an accident tomorrow, do I have enough cash saved up to comfortably pay my deductible on the spot? If the answer is no, you need a lower deductible, even if it costs more per month. Now, if you have a loan on your car or you're leasing it, you don't have a choice here. The bank or leasing company that technically owns your car will require you to have collision coverage. They need to protect their investment. But if you own your car outright, especially if it's an older car with a low market value, you might consider skipping collision coverage altogether. If your 15-year-old car is only worth $2,000 and you have a $1,000 deductible, the most the insurance company would ever pay out is $1,000. You have to ask yourself if paying for that coverage month after month is worth that potential payout. For many people with older, paid-off cars, the answer is no. But a collision isn't the only way your car can be damaged. What if a deer jumps out in front of you on a dark road? What if a massive hailstorm turns your hood into a golf ball? What if you wake up one morning and your car is just gone? Stolen? Or what if a tree branch falls on it during a storm? None of these are a collision in the traditional sense. For all of that, you need the second type of coverage for your own car: comprehensive coverage. Think of comprehensive as the act of God and act of jerk coverage. It covers damage from things other than a collision. This includes theft, vandalism, fire, floods, hail, wind, and hitting an animal. It's for all the weird, unpredictable stuff life throws at your car. Just like collision coverage, comprehensive also comes with a deductible that you have to pay first. And just like collision, if you have a loan or a lease, your lender will require you to have it. Most people buy collision and comprehensive together. In fact, many insurance agents will refer to having both as full coverage. But I want to warn you right now, full coverage is not a real insurance term. It's a myth. It's a piece of slang that can get you into a lot of trouble because it implies that you're covered for everything, and you are absolutely not. It just means you have coverage for your own vehicle on top of the legally required liability. There are still massive gaps that can leave you financially ruined. So we've covered fixing the other person's car and their medical bills. And now we've covered fixing your car. But we've completely ignored one of the most important people in this whole equation, you. What about your own body? If you are at fault for an accident and you break your arm, your liability coverage does nothing for you. Your collision coverage will fix your fender, but it won't pay for your X-ray. For that, we need to talk about coverage for your own injuries. The first layer here is called medical payments coverage, or MedPay. This one is simple. It helps pay for your medical expenses after an accident, regardless of who was at fault. It also covers any passengers who were in your car with you. MedPay can be used to cover things like your health insurance deductible, co-pays for doctor visits, ambulance fees, dental work if you injured your teeth, or chiropractor visits. It's a relatively small amount of coverage, usually ranging from $1,000 to $10,000, and it's meant to handle immediate medical costs without the headache of figuring out fault. It's fast, easy, and it's for you. But in some states, there's an even more powerful version of this called Personal Injury Protection, or PIP. You can think of PIP as MedPay on steroids. Like MedPay, it covers medical expenses for you and your passengers, no matter who caused the accident. But PIP goes so much further. It can also cover lost wages if your injuries prevent you from working for a while. Think about that. If you're out of work for a month recovering, PIP can help replace that lost income, keeping you from falling behind on your rent or mortgage. It can even help pay for services you can no longer perform because of your injury, like childcare or house cleaning. PIP is mandatory in a dozen or so states, often called no-fault states, because the whole idea is to have your own insurance handle your own injuries right away, avoiding long, drawn-out legal battles over who was to blame. Now, a lot of people hear about MedPay and PIP and think, wait a minute, I have good health insurance. Why would I need to pay extra for this? It is a fantastic question. But here's the thing. Your health insurance wasn't designed for car accidents. First, you have your health insurance deductible, which can be thousands of dollars. MedPay or PIP can pay that deductible for you, so you have zero out-of-pocket medical costs. Second, your health plan might not cover certain things common in accident recovery, like acupuncture or specific types of therapy. MedPay and PIP often will. And most importantly, your health insurance will never, ever pay you for your lost wages. If you rely solely on your health plan, you're completely on your own when it comes to the income you lose while you're unable to work. That alone makes PIP coverage one of the most valuable pieces of an insurance policy you can buy, even in states where it's optional. It's the coverage that protects not just your body, but your entire financial life when it's most vulnerable. So we've covered liability for the other guy, collision and comprehensive for your car, and MedPay or PIP for you and your passengers. This is the core of a strong auto insurance policy. You might be thinking that's everything, that you're finally protected. But what about the hidden costs? What about the things that happen after the crash that nobody ever warns you about? What happens when the person who hit you has no insurance at all? Or when your car is in the shop for 3 weeks and you still need to get to work? For that, we need to dive into the lesser-known but absolutely critical add-on coverages. These are the options that can mean the difference between a minor inconvenience and a major financial disaster. Let's start with that first one, the most common scenario. Your car is in the shop after a covered accident, and the mechanic says it'll be 2, maybe 3 weeks. You can't just stop living. The solution is called rental reimbursement coverage. It's exactly what it sounds like. For what is usually just a few extra dollars a month, your insurance company will pay for a rental car while yours is being repaired. Now, it's not a blank check for a Ferrari. Your policy will have limits, typically shown as 2 numbers, like 30/900. That would mean they'll pay up to $30 per day, for a maximum of $900 total per claim. So 30 days at $30 a day. You can often pay a little more to get higher limits, like $50 or even $75 a day, which can be the difference between getting a tiny compact car and an SUV that actually fits your family. For the cost of a couple of coffees a month, this single add-on removes one of the biggest logistical nightmares of a car accident. Next up is the one that saves you from being stranded on the side of a dark highway at 2 in the morning. Roadside assistance. You might already have this through your car manufacturer or a service like AAA, but if you don't, adding it to your auto policy is often the cheapest way to get it. We're talking flat tires, dead batteries, running out of gas, or locking your keys in the car. One call to your insurance company's hotline, and they dispatch a tow truck or a service vehicle to your location. Consider this. A single tow, just one, can easily cost over $100, even $200, depending on where you are and how far you need to go. Roadside assistance on your policy might cost you $20 for the entire year. It is one of the most no-brainer high-value add-ons you can possibly get. It turns a potential crisis into a manageable inconvenience. Okay, now let's talk about the big one. This is, without a doubt, the most financially critical add-on for anyone who is financing or leasing a vehicle, especially a new one. It's called gap insurance. And to understand why it's so important, you need to understand one brutal truth about cars: depreciation. The second you drive a brand new car off the dealer's lot, its value plummets. It might lose 10 to 20% of its value in the first year alone. So let's paint a picture. You buy a beautiful new car for $35,000. You make a small down payment, let's say $2,000, and you finance the rest. A year goes by, you've been making your payments, but you still owe the bank $31,000. Then the unthinkable happens. You're in a serious accident, and your car is declared a total loss. It's totaled. You're okay, but the car is gone. You file a claim. Your insurance company, using your comprehensive or collision coverage, assesses the damage. They determine the actual cash value of your one-year-old car is now only $26,000. That's what it was worth the second before the crash. So they write you a check for $26,000 minus your deductible. Here's the terrifying part. You take that check, but you still owe the bank $31,000. The insurance money isn't enough to pay off your loan. You are now what's called upside down or underwater on your loan. You have no car, and you have to personally write a check for $5,000 to the bank for a vehicle that no longer exists. It is a financial gut punch. This is where gap insurance becomes your absolute hero. GAP stands for Guaranteed Asset Protection. It pays for the gap between what your car is worth and what you still owe on your loan. In our scenario, gap insurance would have stepped in and paid that $5,000 difference directly to the bank. You would walk away with no car but also no debt. You can start fresh. So who needs this? If you made a down payment of less than 20%, if you finance for 60 months or longer, or if you're leasing, you almost certainly need gap insurance. You can often buy it from the dealership, but it is almost always cheaper to add it directly to your auto insurance policy. Don't skip this one if you're financing. It can save you from a $5,000 or even $10,000 disaster. Now let's circle back to something we touched on earlier: uninsured motorists. We talked about how uninsured motorist bodily injury coverage protects you if a driver with no insurance hurts you. But what about your car? In many states, that coverage does nothing for your vehicle. That's where an optional add-on called uninsured motorist property damage, or UMPD, comes in. Imagine someone without insurance illegally changes lanes and smashes into the side of your car. It's clearly their fault, but they have no insurance to pay for your repairs. What are your options? You could sue them personally, which is a long, expensive, and often fruitless process. Or you can use your own collision coverage. But if you do that, you have to pay your collision deductible, which could be $500 or $1,000. You have to pay out of pocket for an accident that was 100% not your fault. It feels incredibly unfair. UMPD is the solution. If you have this coverage, your insurance company will pay for your car's repairs, often with a much lower deductible, maybe $250, or sometimes no deductible at all. It protects your wallet from the irresponsible choices of other drivers. In some cases, it also covers hit and runs, which is functionally the same as being hit by a ghost with no insurance. Let's move to something a little less dramatic, but incredibly common: your windshield. You're driving down the freeway, a truck in front of you kicks up a tiny rock, and you hear that awful smack. A small chip appears, and by the next morning, it has turned into a giant crack that spiders across your entire line of sight. Replacing a modern windshield with all its sensors for rain and lane assist technology can cost anywhere from $500 to well over $1,500. If you only have standard comprehensive coverage, you'd have to pay your full deductible, say $1,000, just to get it fixed. That's a painful bill for something so small. The fix is an add-on called full glass coverage, or sometimes zero deductible glass repair. For a tiny amount extra on your premium, this coverage allows you to get your windshield repaired or replaced with a $0 or very low, like $100 deductible. It encourages you to fix chips and cracks immediately, which is safer, and it saves you from a massive surprise bill down the road. Now, a question for those of you who love your cars: did you add custom wheels? An upgraded sound system with a subwoofer? A special paint job or a vinyl wrap? If you did, you need to know about custom parts and equipment coverage, or CPE. Your standard policy is designed to cover the car as it came from the factory. If your $2,500 custom rims are stolen or damaged in an accident, your insurance will only pay you for the value of the stock, factory wheels. They won't cover your upgrades. CPE coverage extends your comprehensive and collision coverage to protect those investments. You typically buy it in increments like $5,000 of coverage to make sure that if something happens, you can restore your car to the way you built it, not just the way the factory did. Finally, there's one more for the new car owners, and it's a bit different from gap insurance. It's called new car replacement coverage. Let's go back to that scenario where your brand new $35,000 car gets totaled. We know insurance pays the actual cash value, which might be $26,000. Gap insurance pays off your loan, which is great, but it still leaves you without a car and without the cash to go buy another brand new one. New car replacement coverage solves this. If your car is totaled within the first year or two of ownership, the terms vary, this coverage won't just give you the depreciated value. It will give you enough money to go buy a brand new car of the same make and model, effectively ignoring depreciation. It's the ultimate do-over button for a catastrophic accident in a new vehicle. These add-ons, from rental and roadside to gap and glass, are the tools you use to transform a generic one-size-fits-all policy into a suit of armor custom-built for your specific car, your financial situation, and your life. They are what separate basic check-the-box coverage from true comprehensive peace of mind. So let's start bolting on the specialized plates and reinforcements to that suit of armor. These are the optional coverages, often called endorsements or riders, that plug the specific holes a standard policy might leave open. Think of this as the a la carte menu of protection. You don't need everything, but knowing what's available is the key to creating a truly bulletproof plan. First up, and arguably one of the most practical additions for almost anyone, is rental reimbursement coverage. Let's play out a scenario. Someone runs a red light and T-bones your car. The good news is you're okay, and their liability insurance is going to pay for the repairs. The bad news? The body shop says it's going to take 3 weeks to get the parts and fix it properly. 3 weeks. How do you get to work? How do you pick up your kids? How do you get groceries? You have to rent a car. At $40, $50, maybe $60 a day, you're suddenly looking at an unexpected bill for over $1,000 just to maintain your normal life while your car is being fixed. Rental reimbursement coverage solves this. For a few extra dollars a month, your insurance company will cover the cost of a rental car, up to a certain daily limit and a maximum number of days, while your vehicle is in the shop for a covered claim. It is an absolute lifesaver that transforms a major stressful disruption into a minor inconvenience. Next, let's talk about towing and labor, or what's more commonly known as roadside assistance. We've all seen that person stranded on the shoulder of the highway, hazards flashing, looking completely helpless. We've all felt that pang of fear thinking, that could be me. Roadside assistance is the incredibly cheap insurance against being that person. This isn't just for accidents. It's for the realities of car ownership. Your battery dies in a cold parking garage. You get a flat tire on a deserted road at night. You lock your keys in the car, or you run out of gas miles from a station. Without this coverage, you're frantically Googling for a local tow truck, wondering how much they're going to charge you, and a single tow can easily cost over $100. With roadside assistance, you make one call to the number on your insurance card, and help is on the way. The cost of one emergency tow can often pay for several years of this coverage. It's less about the money and more about the safety, security, and immediate access to help when you are at your most vulnerable. Now let's discuss one of the most important and most misunderstood coverages for any first-timer buying a new car: gap insurance. This is not an exaggeration. If you are financing or leasing a brand new vehicle, gap insurance is practically non-negotiable. Here's why. The second you drive a new car off the dealer's lot, it depreciates. It loses value. In its first year, a car can lose 20% or more of its value. The problem is, your car loan doesn't shrink that fast. This creates a gap between what you owe on the car and what the car is actually worth. Let's use real numbers. You buy a new car for $30,000. You make a small down payment and finance $28,000. 6 months later, you're in a terrible accident and your car is declared a total loss. You've been making payments, so you still owe, let's say, $26,500 on your loan. But because of depreciation, the insurance company determines the actual cash value of your car is only $22,000. They will write you a check for $22,000. That's all your collision coverage owes you. But you still have to pay the bank $26,500. This means you have to pull $4,500 out of your own pocket to pay off the loan for a car that no longer exists. And you still have to find a way to buy a new car. It's a financial nightmare. Gap insurance covers that exact gap. In this scenario, it would pay the $4,500 difference, leaving you with a zero balance on your loan and free to start fresh. You only need it when you're upside down on your loan. Once you owe less than the car is worth, you can and should cancel it. For those who want an even higher level of protection on a new car, there's new car replacement coverage. This is like gap insurance on steroids. While gap just pays off your loan, new car replacement goes a giant step further. If your new car is totaled within a specific time frame, like the first 1 or 2 years or before it hits 20,000 miles, the insurance company won't just give you the depreciated cash value. They will pay to replace it with a brand new car of the same make and model. No haggling over value. No worrying about depreciation. You wreck your 1-year-old Honda Civic, you get a brand new Honda Civic. It's the ultimate do-over button for a catastrophic loss, offering complete peace of mind for your brand new investment. Now let's talk to the enthusiasts. Did you add a custom sound system? What about those expensive aftermarket wheels and tires? A special paint job or a performance exhaust? If you've invested money into personalizing your car, you need to look at custom parts and equipment coverage, or CPE. Your standard comprehensive and collision coverage is designed to repair or replace factory-installed parts only. So if you get into an accident and your $3,000 custom wheels are destroyed, your standard policy will only give you the value of the basic stock wheels that came with the car. All that money you invested? Gone. CPE coverage is an endorsement that specifically increases the coverage limit for your custom parts. You're essentially telling the insurance company, hey, my car has extra value because of these specific upgrades, and I want them to be protected too. You'll need to provide receipts and photos, but it ensures that if the worst happens, you get the money to restore your car to the way you built it. In our modern gig economy, another coverage has become absolutely essential for a growing number of people: rideshare coverage. If you drive for Uber, Lyft, or any other delivery service, you cannot assume your personal auto policy covers you while you're working. In fact, it almost certainly doesn't. This creates a terrifying insurance gap. The rideshare companies provide coverage, but it's typically broken into phases. When the app is off, your personal policy applies. When you've accepted a ride and are on your way to a passenger or have them in the car, the company's full commercial policy applies. But what about that critical time in between? When your app is on and you're waiting for a ride request. During this phase, you are technically working, so your personal policy denies the claim. But the rideshare company's insurance provides only minimal liability coverage and often zero coverage for your own car. If you get into an accident during this period, you could be on your own. Rideshare coverage is an endorsement to your personal policy that fills this specific gap, protecting you during that vulnerable waiting period. If you plan to ever turn on that app, this is not optional. It's a requirement to protect your financial future. Finally, there are other more specialized coverages that show just how customized a policy can be. Things like pet injury coverage, which helps pay for vet bills if your furry friend is hurt in a car accident. Or accident forgiveness, a feature many companies offer to loyal customers with a good driving record, where they won't raise your rates after your first at-fault accident. It's a reward for your safe driving and loyalty. This is the toolkit: rental reimbursement, roadside assistance, gap insurance, new car replacement, custom parts, rideshare coverage. These aren't just random add-ons designed to make your bill higher. Each one is a solution to a specific real-world problem. Your job isn't to buy all of them. Your job is to look at your car, your finances, and your lifestyle and ask, which of these problems am I most likely to face? Which of these risks do I want to transfer to the insurance company? By selecting the right ones, you're no longer just buying insurance. You are designing a personalized shield. You now have a complete 360-degree understanding of what auto insurance is and what it does. You know the core coverages, you understand the numbers, and you've seen the custom options. You are now more educated on this topic than 95% of the drivers on the road. There is only one thing left to do. It's time to take all this knowledge and turn it into action. It's time to go shopping. And this is where the rubber meets the road, literally. Shopping for insurance isn't like browsing for a new pair of sneakers. It requires a strategy. But don't worry, you have one now. We're going to walk through this step by step. First, you need to gather your arsenal. Before you even type a single web address or dial a number, have all your information ready. This will make the process 1,000 times smoother. You'll need your driver's license number. You'll need the vehicle identification number, or VIN, for the car you want to insure. This is a 17-digit code usually found on the driver's side dashboard near the windshield or on the door jamb sticker. You'll need the physical address where the car will be parked most of the time. This is called the garaging address. You'll also need to know the year, make, and model of the car. Finally, have a rough idea of how many miles you expect to drive per year. And yes, many companies will ask for your social security number. This might feel invasive, but in most states, they use it to pull a credit-based insurance score, which is a major factor in determining your rate. It's a standard part of the process. Okay, you've got your info packet ready. Now where do you go? You have 4 main paths you can take, and the best one depends on your personality. Path number 1. Go directly to the insurance carriers. This is the DIY approach. You go to the websites of companies like Geico, Progressive, or Liberty Mutual and fill out their quote forms one by one. The upside is you have total control and there's no middleman. The downside is it's incredibly time-consuming. You'll be entering the same information over and over again. Path number 2. Work with a captive agent. These are agents who work for one single company like State Farm, Allstate, or Farmers. The major benefit here is personalized service. This person will know their company's products inside and out and can help tailor a policy specifically for you. The obvious drawback is that they can only sell you one brand. They can't tell you if a competitor down the street has a better rate for the exact same coverage. Path number 3. Partner with an independent agent or broker. This is the guided tour approach. Independent agents work with multiple insurance companies. Their job is to take your information and shop it around to all the carriers they have a relationship with to find you the best combination of coverage and price. This can save you a ton of time, and they often find deals you wouldn't find on your own. The only potential downside is they don't represent every company. Some big names like Geico only sell directly to consumers. Path number 4. Use an online comparison tool. Think of sites like the Zebra or Insurify. You enter your information once, and they pull up a list of preliminary quotes from a bunch of different companies. This is the fastest way to get a bird's-eye view of the market. The caution here is that these quotes are often estimates. You'll still have to click through to the actual insurance company's website to finalize the price. And be warned, this path can sometimes lead to a lot of follow-up emails and phone calls. So which path is for you? If you're a hands-on person who wants to control everything, go direct. If you value a long-term relationship and expert advice on one specific brand, find a captive agent. If you want someone to do the heavy lifting and compare multiple options for you, an independent agent is your best bet. And if you just want a quick snapshot of prices, start with a comparison tool. My recommendation for a first-timer? Start with an independent agent, and then get 1 or 2 direct quotes yourself from companies they don't represent. This gives you the best of both worlds. Now, the most critical part of the entire shopping process. You must compare apples to apples. This is the number 1 mistake first-timers make. You get a quote from Company A for $80 a month and a quote from Company B for $120 a month, and you immediately think Company A is cheaper. But what if Company A quoted you the state minimum liability, while Company B quoted you the robust 100/300/100 limits we talked about? What if Company A has a $1,000 deductible, and Company B has a $500 one? They are not the same product. When you get a quote, you need to look at the details. Write them down. Create a spreadsheet if you have to. For every single quote, check the bodily injury liability limits, the property damage liability limits, the uninsured motorist limits, and the deductibles for collision and comprehensive. Make them identical across every quote you get. Tell the agent, I want a quote for 100/300/100 liability, with 100/300 for uninsured motorist, and a $500 deductible on both comp and collision. Now when you get prices, you are making a true fair comparison. You're comparing the price of the exact same basket of goods from different stores. Aim to get at least 3 to 5 quotes. This is the sweet spot. It gives you a clear sense of the market without overwhelming you. Once you have your apples-to-apples quotes lined up, your decision is made, right? Just pick the cheapest one? Not so fast. Price is a huge factor, but it's not the only factor. A policy that's $10 a month cheaper is a terrible deal if the company is a nightmare to deal with when you actually need them. So, how do you vet the company itself? You do a little more homework. First, look at customer service and claim satisfaction ratings. Organizations like J.D. Power release annual auto insurance studies that rank companies based on feedback from real customers. A company that consistently ranks high for claims handling is worth its weight in gold. Second, check their complaint record. Every state has a Department of Insurance, and you can often look up a company's complaint ratio. The National Association of Insurance Commissioners also has a complaint index tool on their website. This tells you if a company gets more or fewer complaints than you'd expect for its size. Third, look at their financial strength. You want to be sure that if a major catastrophe happens, your insurance company has the money to pay your claim. Independent agencies like AM best rate the financial stability of insurance companies. Look for a rating of A or better. This means they are considered financially solid. And finally, consider the user experience. In today's world, this matters. Do they have a good, easy-to-use mobile app? Can you easily pay your bill, view your ID cards, and start a claim from your phone? For some people, a clunky website and a terrible app is a deal breaker, and that's a perfectly valid reason to choose one company over another, even if it costs a few extra dollars. So you've done it. You've gathered your information. You've gotten multiple apples-to-apples quotes. You've researched the companies and found one with a great price, solid customer service, and strong financial backing. You've made your choice. The final step is to seal the deal. You'll contact the agent or company and say you're ready to purchase the policy. They will walk you through the final application, which will include signing some documents electronically. You'll make your first payment, which you can often do with a credit card or bank transfer. And the moment that payment is processed, you are insured. They will immediately send you proof of insurance, usually as a PDF. Save this to your phone and print a copy to put in your glove box right away. You are now officially and legally insured. Let's just take a moment and zoom out. You started this journey probably knowing very little about this topic. You learned about liability, the bedrock of your protection. You learned how to protect your own car with collision and comprehensive. You discovered the vital importance of uninsured motorist coverage. You explored medical payments, rental reimbursement, and roadside assistance. You understood how deductibles work and how to choose the right limits for your life. And then you took all that knowledge and learned how to apply it in the real world, how to shop smart, compare fairly, and choose a company that will actually be there for you. You didn't just learn how to buy a product. You learned how to make one of the most important financial decisions a driver can make. You are now in the driver's seat, not just of your car, but of this entire process. You've gone from a first-timer to an informed consumer, capable of protecting yourself, your passengers, and your financial future. Go out there, get those quotes, and drive with the peace of mind that comes from being truly and properly protected. You've earned it.